My name is Mike Garrett. I'm with a company called Movement Mortgage. Our office is, my office is in West Cobb. Our corporate office is in a place called Indian Land, South Carolina, which is, we technically claim to be headquartered in Charlotte, which is where they originally were, but as a lot of companies move for tax purposes, they moved straight across the line, and Indian Land, South Carolina is like 15 minutes from Charlotte for tax purposes into South Carolina versus North Carolina. So I've been in the mortgage business for roughly 20 years now. I've got a great team that works with me of assistants and a processor. And last year we did roughly 400 loans that we closed last year. So we do a decent amount. And so that's allowed us to see a lot of things and kind of learn a lot of different things throughout the years. So who all has been through the loan process and bought a house? One, two? Okay. How long has it been since you went through the process?
My last purchase was when I moved here 6.5 years ago.
Okay.
I refiled last February.
Last February, okay, so pretty recent that you've been through it.
Mm-hmm.
So it's been really interesting. I've been doing this, like I said, for roughly 20 years. So I went through 2008 when the housing market collapsed. So the one thing I would tell you, because of what you're going into, you probably have had people, hopefully that you understand that this is not true, but there are plenty of people who will tell you that the housing market's getting ready to crash. And it's what plenty of people believe. I can tell you that there's zero evidence that that would take place. That's because we have a huge shortage of inventory of homes, and that's not supposed to get corrected for at least the next decade. So that means that when you have a shortage, supply and demand of economics, if you go all the way back to school, tells you that prices can't go down when you have a shortage of something. It's why you see that you have everything you buy now costs more money than it did 3 years ago, because it's a shortage. And so houses are no different. So to kind of go through the loan process, the way that we handle everything and the way it leads up to where you guys would be involved in closing. A lot of things are done online now, makes it easy as long as people understand how to do all of that. But we offer the ability to sit down with somebody and do an application in person or over the phone, or they can do it online. But we complete the application. From there, we're going to pull credit, go through everything, look at their debt to income ratio, how much they have in assets, and analyze the credit. And then we put together their full pre-approval, and then what's called a total cost analysis is what we offer. And it's basically it's a link where I record a video and put together numbers for them to be able to look at to see all the different financing options that they have. We use video because I think that video helps integrate technology into more of an old school personal touch and allows people in a digital age to feel more connected. So we use videos for a lot of different things, but that's where a lot of the stuff really starts to take place, is in the numbers. In looking at, we kind of start from a standpoint of what's the maximum that somebody's approved for, and then our conversation with them is geared around, just because the bank says that you can borrow $400,000 doesn't mean you should borrow $400,000. It's super nice to have a nice house. Everybody wants to have a nice house. But if you have a nice house and you have to eat ramen noodles every day, or as I was always told that it was crackhead soup. And so if you have to eat that every day, then it's really not worth having a nice house if that's all you get to do.
House poor. I call that house poor.
Yes. So we kind of talk about it from a standpoint then of what does somebody's, where are you comfortable payment wise, and what does that equate to from a house price perspective. And then so we'll go through those different numbers with them and make sure that they're comfortable with where they want to be. And there are often times where, it may be that, we say that they could do 400 and they're comfortable at 250. But then after they get out looking, it's like, all right, I got to go to 300, because I can't get anything at 250 or can't get what I need. So I've got to go a little bit. I don't have to go all the way to where I could have gone, but they have to bump it a little bit. And that's, a lot of the back and forth between the loan officer and the client is making sure that they're comfortable and understand the process and what their numbers are gonna be. There are multiple things, and as you guys go through, you'll see these somewhat when or you'll certainly hear it from attorneys or, from people at closings as you deal with them. There are some companies, some loan officers that the whole goal and objective is to win the business. And you can do so by lowballing certain numbers and making the numbers look better than what they really are. And that may get the business, but it doesn't build a relationship with somebody, because then they're gonna show up at the closing table at an attorney's office or a title company, and it's going to be way different, and they're gonna need more money. But at that point, it's too late. Like, they're gonna have to come up with the money. So it gets that loan, but it doesn't build a relationship and doesn't build referrals. And so everything that we go off of is basically trying to make sure that the numbers we give somebody are more than what they're going to need, so that at the closing table, they need less than what we actually told them originally. And so that's where the communication between us and the title company or the attorney's office really starts up front, of knowing, what those fees are, what's gonna be charged, because every company's gonna be a little different. They're all close, but they're gonna be a little different. I think that there's probably about a $700 price difference between the most expensive in the Atlanta metro area and the cheapest. And so, so we try to make sure that we know who's gonna be handling it, so that when we put those estimates together, that we're giving an accurate comparison of what they're gonna look at. So from there, they're gonna go and find a home, get it under contract, and then the loan process is gonna start. And then we're gonna order title work through the attorney's office, and all that's gonna be run through the title examiner. You guys have gone through all that, you know how that process works. So what happens after that, once we get all the title work back, preliminary CD, all those different documents that the attorney's office is gonna provide, then our closers prepare the initial closing documents, and then send that over to you guys to then look at and kind of do a collaboration to put together what the final numbers are gonna be. And so our goal always as a lender is to try to get everything to you several days before closing. Doesn't always happen, but we try to do that. There are certain times, and you will find as you go through this that there are some companies that are better at it than others. And some companies that'll be, if it's closing at 4 o'clock today, you may get it at 2 o'clock. There are others who it's closing at 4 and you got it several days ago. And so, that's one of the things that's really changed, that you guys will see that, somebody going through this a couple years ago didn't ever experience, is the digital signing of closing stuff. And so now, through our company, and most companies are this way now, the client can digitally sign or electronically sign most of their closing documents before they ever get to the closing table with the attorney. And so it makes the closing go that much faster, because there's only certain documents that have to be wet signed in person. And it's the note, the deed, the final closing documents. But a lot of the other stuff they can sign electronically beforehand, which will help speed up the process. And so as you get emails from a mortgage company, you'll kind of get like 2 different sets of directions, one to do an entire package and one to do a skinny or a smaller digital package that is based on them having already signed. Because they have to digitally sign it the day of closing. Like, we send the email at 2 o'clock in the morning. That way we know that there was no chance it could have been signed before. So they basically wake up that morning of closing and can sign it on their phone or computer before they ever go to the attorney's office. On market stuff right now, so most of you, if you remember 2008, probably believe that if we have a recession, that housing is not going to go well. Would you believe that?
Well, for who?
that housing is impacted negatively in a recession.
Again, for who, like for the buyer?
For anybody, so that if you're a homeowner, that prices are gonna drop, that those types of things. Most people believe that that's true because our brains are very short memory. And the last recession we had was 2008, and housing plummeted. And the reason why is because that recession was driven by housing. But historically, if you look over time, housing does very well during a recession, because generally when you get a recession, one of the ways to get out of a recession is interest rates become cheaper. And so then it's cheaper to borrow money, which helps to come out of a recession, and housing does well when it's cheaper to borrow money. Right now, it is the most expensive that it's been in a couple of years to borrow money, and interest rates are roughly 1% higher than they were 6 weeks ago. It's been a crazy run up of interest rates. And most experts believe that we will have a recession in the next 12 months. And the reason for that is, without getting too technical, so you have a 2-year treasury and a 10-year treasury, and they're bonds that you can purchase. It would stand to reason that if you buy a 10-year treasury, meaning that you give somebody money for 10 years, you should get a higher rate of return than if you give somebody money for 2 years. They should give you more money. With the actions that are going to take place from the Federal Reserve in raising their rates, which don't impact mortgage rates, they impact what banks charge each other, or what the Federal Reserve charges a bank. So what they're doing when they raise that is going to cause the 10-year treasury to go down and the 2-year treasury to go up. And every time in the history of our country, when those two get inverted, meaning that you can get more money back for a 2-year than a 10-year, it's called an inverted yield curve. And every time that happens, there's a recession that follows it. And that used to be here, and it's been slowly getting, and now it's like this. And as soon as they start to raise rates, it's going to invert. And so that's going to happen soon, which will cause a recession. But like I said, historically, in most recessions, housing does very well. So I wouldn't panic and worry about it from a housing standpoint or from a job standpoint of something being in housing related industry. So most people panic about it because all they remember is what happened in 2008. And I can tell you, because I was in it, and it did not go well. So it was, to give you a perspective, in May of 2008, and I wasn't doing near the amount of business then, but in May of 2008, I had closed roughly $7 million in loans by that point for the year. By the end of the year, we finished less than $9 million. So we did less than $2 million in loans the entire rest of the year, which, if you're 100% commission, not very fun. So it's, but now, like, the market is so much different now. I mean, to put into perspective, last year we did 100 million in loans. So it's a big difference from where we were back then. And to kind of put into perspective on the number of homes that we talked about, some of you may have seen or remember back in the day. Is anybody from here originally?
Right. Atlanta or
Africa? Atlanta metro area. Yeah. All right, so mid-2000s, Metro Brokers Real Estate put up billboards. And on those billboards, they kind of took, if you remember way back in the day, in downtown Atlanta, they had the digital deal that said the population in Atlanta. So Metro Brokers stole that idea, or borrowed that idea, and said, we're gonna apply that to homes. And so they had billboards around Atlanta that said, this is how many homes are for sale in the Atlanta metro area. And in 2007, there were over 110,000 homes for sale in the metro area. And that's all the counties around the metro area. You know, it kind of goes from Douglas County out to, Stone Mountain and that area. So, and then down to Henry County, all the way up to, I think Bartow and Cherokee are still technically considered metro area. So now that number for all those counties is less than 10,000. and there was over 110,000. So that's a huge difference. When you factor that in with the average first-time home buyer is roughly early 30s. And so the number that experts use when they look backwards from that standpoint is 33 years. So if you go from 2006, which is widely regarded as the peak of the housing market, so that would take you back to 1973, and you took birth rates in 1973, they were here. If you went from last year and went 33 years backwards, so now you're 1988, birth rates are here. So there are way more birth rates in 88 than there were in 73, which gives you then more population, more people buying homes, people live longer, therefore they need homes longer. So all those things are the reasons why we have a shortage of homes over what we used to have. So, what questions do you guys have on the lending process, numbers, why things are done, how they're done, how it impacts you? Yes, ma'am.
Based on what you just said, what percentage of your loans now are you seeing as new construction purchases?
Probably,
Bigger.
probably 10 to 15%.
That's it.
Yeah. So, and there are some places where it's going to be more. And one of the things to keep in mind is that your larger, so Georgia historically has not been a national big builder area. It was a lot of smaller builders that built homes. But now you have a lot more of the national builders like a D.R. Horton
Right.
and things like that. Well, D.R. Horton owns their own mortgage company,
Oh, I see.
so they're gonna do all of those loans, so somebody
Gotcha.
like me is not gonna see
Okay.
those.
Everywhere
So-
you look, there's new construction.
Yeah.
Yeah. It's, you know, and that's one of the things that will help us, is obviously new construction. And so it just is gonna, you know, they were going well, and then you had COVID start, then you had supply chain issues and material shortage, and there's still certain issues where, you know, somebody's building a home and they may want this refrigerator or this window or this garage door, can't get it. Like, just gotta put whatever you can in there. So it's just, you know, who knows how long that's gonna take to get fixed. Yes, ma'am.
What can we do at the settlement agent's office to make the closing process more smoother?
Good question. You know, I think that everything in the entire process for everybody is just all communication. It's just being open and communicating, and realizing that everybody's on the same page to accomplish the same goal. It's, you know, there are some places that you will find, you know, real estate agents, loan officers, even, you know, pre-closers and closers that don't want to work at. And part of it is some of those companies made the settlement, you know, companies made a choice several years ago that they were going to represent banks on foreclosures, and they didn't care about anybody else. They didn't care about service or communication and how anybody else felt, because all their business was coming from this place and they didn't care about that. Well, that worked out great until that business didn't exist, and now you needed all these people. Well, you upset all these people because you didn't want to be nice to them, and now they don't want to use you. So it's, everything kind of runs in cycles, and there were agents who did that, who, you know, represented banks and didn't want to communicate with people. And then when that business went away, they had to go back to doing regular real estate, and it hurt them. And so it's just always remembering that it's a long-term deal, and everybody has to work together and communicate on it. Only, you know, because I was just there yesterday, and I'm sorry that she happens to be her mom, but like, so Susan is fantastic about always being, you know, willing to help and, you know, going the extra mile to really make things easier for us. And she's one of many that do that. But because of that, like, anytime if we have the choice, and most of the time real estate agents are the one who choose, at least on a purchase, but on a refinance, we always get to choose unless the client knows somebody. Then it's, we're gonna say, hey, let's go where it's gonna be the easiest, where they're gonna work with us and, not make things to where you're having to beg them to take your business. So, your mom is fantastic.
That's so cool.
What law firms do you work with the most?
My office is off of Dallas Highway by the Avenue at West Cobb. And so, are you familiar with that area? So you know where the Honey Baked Ham is? So my office is down in that little area,
Okay.
which is great except for Thanksgiving week and Christmas week.
Yeah.
And it sucks because then I have to sit in traffic waiting to get out.
Yeah.
But right next to us is a kind of a horseshoe-shaped parking area with multiple, I think there's 6 real estate attorneys right there. And most of my real estate agents kind of work that area, so we close a lot there. I have several builders that are out in Douglasville, and so they close with her grandfather's office. And so that's kind of really the only one that I close out in Douglasville, and then
Okay.
there's another one in Paulding County that I have another builder that uses. It's called Talley Richardson and Cable. So, yes, ma'am.
Can a lender drop your interest rate if the market rates decrease
So after closing or before?
after?
After closing, really the only way to do it is with a loan modification, which generally, up until a couple years ago, nobody ever really even knew what a modification was.
Mm-hmm.
So it's not generally something that's done.
Okay.
Most of the time you have to refinance it to drop the interest rate.
Okay.
Before that, you can, before it closes, they can lock in a rate on one thing and then they can do what's called a float down if the market got better and get it down to the lower rate. So there are certain times where a bank may, if they're servicing the loan, may say, hey, we'll basically change your rate. You got to sign a few paperwork. And so it's still a modification, but it's a semi-refinance.
Right.
And just for argument's sake, let's say you were at a 4.5% rate and rates were 3.5%. They probably wouldn't go all the way to 3.5%, but they may say, we'll do this, but we'll go to 3.875. And you got to sign these papers and we'll keep your term at the same. So if you had 27 years left, they'll keep it at the 27 just with a lower rate.
Okay.
So,
But they could never increase it, right?
Could never
If it-
increase it,
okay,
correct.
so that'd be a little messed up.
correct. Once it's locked in, you are
Yeah.
good. And it stays that until you choose to have it changed by refinancing.
Can you talk, Mike, about the difference between pre-qualification and pre-approval?
Oh.
Because that's
Yeah.
a big deal now.
Yeah, so pre-qualification is basically you and I talking and you saying, my credit is, 720 and these are my debts and this is my income. And we say, okay, you could buy a $300,000 house. It does you absolutely no good.
Right.
I've never done a pre-qualification. Everything we do is pre-approval. We pull a credit report. We look at everything. And we'll have people that will, that don't necessarily understand the processes as well. And they'll say, well, this is how much money I make and how much house can I afford? And while there are calculators that will tell you like, hey, if you make $40,000, you can buy this much house. Well, how can that be accurate? Because if I drive a $200 a month, Kia, whatever, that's 15 years old, and you drive a brand new Cadillac Escalade,
I was about to say.
and we make the same amount of money, I can buy more house than you can
Right.
because you have money going other places.
Right.
So without looking at everything, there's just no way to know, and that's the only way that we do it is by
So you look
and
at all
most
the other assets, like
We-
everything
everything.
you have money in?
everything that you have money in, what your debts are, and people get confused on debts and they think it's about what your balance is, but it's just about what your payment is. So because everything's based on debt to income ratio, it's based on what your total payments are per month. And so there are times where, we'll take somebody and say, You said you wanted to put $20,000 down. However, if we lower your down payment to $15,000 and you take $5,000 and you pay off this credit card, that $5,000 on a loan for a mortgage may only change your payment by $30. But $5,000 on a credit card may be $150. Well, now that's an extra $100 a month, $120 a month, which then if you factor in what that really means at the end, that means that now your approval can go up another $25,000. You spent the same amount of money, but your cash flow is now distributed differently, so now you can buy more house. And so cars really are what add up. Student loans they've gotten a little better. It used to be that most loan programs, if you had a student loan, even if they were in deferment, meaning that you don't have to make payments, they would count 1% of whatever that balance was. And so now that they count 0.5%. And not that this is not a good place to get an education. It's a beautiful college. I'm not disparaging it. I've had plenty of people that have gone there, but just as an example, because it is on the higher end of cost. For an example, you go to Berry College in Rome. It's an expensive college.
Don't graduate from here.
It's an expensive college.
It is.
And so I've had people that have gone to school there and they've got, they borrowed everything. And they've got $140,000 in student loans and they're working as a teacher making $42,000. Well, they're going to be able to do less than the person who went to Kennesaw State and has the exact same job and exact same pay, but way less in student loan debt. So sometimes you have to think about that, and we've had attorneys and doctors that, $300,000 or $400,000 in student loans.
It's like Faded Glory or Nike, but they both do the job.
Right.
Like.
Yeah. What other questions?
That's a good one. What's the most difficult part of what you do?
I think it's just managing expectations for people, especially right now. So right now we are, we talked about rates having gone up a good bit. So right now I have a little over 80 people that we have a pre-approval on that are trying to find a house. Okay, which is an insane amount of people. We don't normally have near that many. And so some of those go back to October. Well, interest rates are way higher now, 1.5 points higher than they were in October. And so my job then is I have to basically go back every week to 2 weeks and redo a pre-approval on these people, because otherwise they go to the realtor and they have a letter that says they can buy 400. Well, that 400 was when rates were 2.75. Now with where rates are, they can buy 360. But if I don't redo that, then what happens is they go and they put a house under contract and it's 390, and then I get it and I'm like, hey, yeah, sorry, they can't buy that now. But you gave me a letter that said that they could. Yeah, rates went up. And it's like, well, it'd have been nice for you to have told me that before I went and wrote the offer and got them under contract. So we have to be proactive and manage that to stay on top of it, to keep that from happening. And it amazes me, like, so I, and this is an example of how the market goes, like, so I just got a text that says alert to lock, because the market's down 37 basis points, which means rates are going up today. So so we follow that and monitor it nonstop, so that if we have somebody that is not locked in, that we can go and get that done. So there are, historically, rates on a 30-year loan have been, let's say 2.5 was the lowest that a 30-year loan ever got to. It may not have been quite that low, or it may have been a little bit lower, but roughly thereabouts. They've also been as high as, who knows what the highest have ever been, roughly.
I don't know the highest, but I know the first loan I ever did in 1983 was 18% FHAR.
Roughly 18%.
18,
Yeah.
that sounds so high.
And so,
I was just talking about that with my mom about one of our old houses from
Yeah.
my childhood was over 25%.
yeah.
I was gonna
Yeah.
say like 10.
Yeah.
Jesus.
So in the mid 2000s, when the market was really good, if you had good credit, rates in 2006 or so were like 5 to 6.5%. But you had subprime loans, which were 8.5 to 10%. And so it always makes me chuckle when people will complain when they hear 4%. I'm like, and so the way that I always phrase it back to people is I said, okay, if I came to you and I said, hey, loan me $100,000 and I'm going to give you a 4% return on your money for the next 30 years, would you loan me that money? And most people, the answer is no, I will not. I will take my chances with my money doing something else. And so I said, so the answer is always then, if you wouldn't take that as a return, then it's a good deal if you can borrow money at that. If you would take that as a return, then it's not a good deal for you to borrow it at that. And so it's, you know, we'll get somebody who will say, God, that's so bad. I can't believe it's, 4%. And I'll be like, I'm kind of looking, and you've got $20,000 in credit card debt that I know you pay way higher than 4% on. And you don't seem to care about that interest rate, but you're upset about this one. And so I'm just upfront and honest with people. Most of the time when you put it into those types of terms, it hits home and they're like, all right, well, that makes sense. And right now, we use what rates do a lot because you probably have seen, because everybody knows realtors, like everybody, because so many people have gotten into real estate. And the biggest thing that they've put on social media lately is, here's what, this house would cost you with this interest rate. If the house goes down in price, but the rate goes up, here's what your payment is. And so if prices drop 10%, but rates go up 1%, you still are paying more per month for that house. And that's what people don't think about. We have so many people that right now, just no matter what we tell them, they're like, yeah, I'm going to wait till prices come down. Well, they're not going to come down, and rates are going to go up, and you're going to pay more money. But you can only tell people that, and they have to experience it and see that it's happening before they will then react and make a move on it. But that's the biggest thing that we go through with people right now is education of where the market is, what's going to make it change, where it's going. And to go back to the time frame that you were talking about, if you go and you look up, not that this is where rates are going to go, I don't think we would ever see that period again, but if you look at the period from 2020 through now, and you look at the period from 1980 through like 1982, it is very, very similar. Inflation is through the roof. Inflation at that point in 1980 was 9%, or high 8s. And the Federal Reserve reacted by raising rates, and, it led to a lot of different things. And so it's not much different now than what it was in 1980. So.
We've talked about how the whole thing is so cyclical anyway. You have good days and bad days, but people always need a place to live. They're going to buy a house no matter what the rate is.
Yep. It's one of the things that we kind of go through with people is people don't really understand how much just a little bit of how little an extra $1,000 changes it. Because we'll get people that'll say, well, I want to put $2,000 more down. And be like, well, we can do that, but that $2,000 is going to change your payment by $12. Is that really worth spending $2,000 on? Like, if you took that $12 a month that you just saved and put it into a bank account, it'd take you a long time to get the $2,000 back. You're better off just keeping the $2,000 or paying something else off, because most people would feel more comfortable if their debts were $12 more per month, but they had $2,000 in the bank as a cushion, than if they had $2,000 less in the bank, but their debts were $12 a month less. That $12 isn't going to change how you live. The $2,000 changes how you feel. So.
That's good.
My mom said, hey.
Oh, awesome.
She said,
You guys gotta get a picture.
yesterday.
So is it still standard for homeowners to put down like 20% on a house?
So you can do So kind of go through different loans. So USDA loans, which is a rural housing loan, doesn't mean that you have to buy cattle with it. It is just a rural housing loan. There's nothing in Cobb County. There is some stuff in Paulding, but it's kind of northwest Paulding and way west Paulding. So that loan, you can do 100%. It's a great loan. You can only make over a certain amount of money and you have to buy in a certain area. You can do 100%. VA loans, which are for veterans, they can do 100% loan. Conventional loans, the standard is a 5% down is the minimum, but there are two different options with 3% down. One is for first-time home buyers, and then another is income-based. If you make below a certain amount, then you can do 3%. But outside of that, anybody could do 5%. And then FHA loans require 3.5% down, and FHA loans are meant for higher debt to income ratios or lower credit scores. So there are still, plenty of people that do put 20% down. But, I would say on average, probably it's roughly around 10%. When you factor the people that put the low and the high, it probably works out to close to 10.
Gotcha. Should a buyer, so someone interested in buying the house, start with the lender pre-approval first before contacting a realtor? Like, are you really the first point of
So
contact?
most people have talked to a realtor first, and
Okay.
then because so most of our business is a referral from a realtor.
Okay.
Some people do start with us first. They're referred from a previous client or saw something online or whatever, and then they go to a realtor. But most people start with a realtor, and then they come to us. But before they go look at homes, it's
Usually.
yeah, and especially right now because you're not gonna be able to make an offer without a pre-approval letter. And if an agent goes and shows homes without it, they're kind of wasting time because you have to have it to make the offer. Nobody's gonna even look at it, and you have to make the offer so quick that you don't have time once you find it to then go do that. You need to have all that done beforehand. And it's, I always tell realtors that, even if you knew that they were good and could buy something, we're all this way, that, if you were seriously looking with the intent to purchase a home, not just because you wanted to go see what something looked like, but if you're looking and you thought, hey, I can buy homes in the 400s, and you're looking at homes that are 450 and 475, and you can only buy homes that are low 300s, you're not gonna like that home at 310 after you've been looking at homes that were 475. You're gonna be like, well, this one, the bathroom's not as big, or the closet's not as big, or the kitchen's not as nice. Well, yeah, it's $160,000 less, but that's all you can get. But after looking at all these, now you don't like those homes. When if you just looked at those, you're like, oh, this is nice, I like this. It's just how our brains work. Yes, ma'am.
Do y'all do underwriting like in-house?
Mm-hmm.
Okay.
So we are a direct lender, so there's three types of lenders generally. You have a broker, and what a broker does is I take your information, and then I look at 10 different companies or 20 different companies, whatever, and find out who's gonna give the best rate to you and me the most money for your lowest rate. And then we're gonna send that loan to them, they're gonna underwrite it, they're gonna do everything, they're gonna fund it and close it.
Okay.
But all we did was start it and then broker it out to somebody else.
Okay.
Then you have a bank, which is an FDIC institution. All they do is what their bank does. So that's a Wells Fargo, Bank of America type place. Then you have what's called direct lenders or correspondent lenders. And we have warehouse lines. We lend our own money. We underwrite the loan, close the loan, fund it, do everything in our name. And then they have two options from that point. They can either keep it and service it. And servicing is who you make your payments to on a monthly basis, or they can sell it and let somebody else deal with that. We service all of ours. So if I close a loan for somebody, 5 years from now, they're still getting a monthly statement. That monthly statement still has my pretty face on it, and they see it every month because the loan never leaves our company. So
How long does the pre-approval process usually take?
So if somebody's a W-2 employee, it can be from the time they complete the application and, upload documents, 30, 45 minutes. I mean, it's super quick and easy.
Okay.
If somebody's self-employed and we need tax returns and different things, then it can be a little bit longer, depending on how complicated their tax returns are, how many businesses, how many rental properties, things like that. It can take a few hours to a day or so to review everything.
That's quick.
Yeah, so it's still not bad.
Yeah.
There's systems now that are in place that, if a loan officer wanted to and they weren't very good at calculating and analyzing tax returns, you can send them to a place that's called Loan Beam. They analyze it and they basically say, this is what Fannie Mae says the amount is, that's just what you can use, and you don't have to do any work. I don't know why somebody would need to use them, because there's spreadsheets that are available that literally are plug and play, that literally will say, look at the corporate tax return on this line, look at that and put it in that space. It'll tell you the next line, you go and you find it and put that number in, and it calculates it and tells you what the income is. So it's pretty easy. It's just a matter of putting everything in the right place.
Assuming the borrower gets you the information.
Correct.
That's where the holdup is.
And you get, it would amaze you the amount of times, and these are the things that can kind of delay a loan process, where we literally, and it happens a lot with small companies, obviously not a Home Depot or a Coca-Cola type place, but a smaller mom and pop, where we will submit a verification of employment form to the company, they will complete it, and it'll say, this person made $52,400 last year. I got a W-2 that said they made $59,000. I got pay stubs that said they made $60,000. And all three documents have different amounts. Well, they should be the same, but all three of them have different amounts. And so then you're having to figure out what really their income is. So when you've got that, it can kind of slow the process down.
How often do you see like identity theft or fraud come through?
Not very often on identity theft. I think people just know that that's so tough to do. I think especially for a local place, they may try more on an online place to try to do something like that. What we see more often than not is, so this is the most prevalent thing that happens, because child support really can impact somebody's ability to purchase a home because they've got to pay child support. But what happens is, or they need child support income. Let's say that they're getting child support income and they need it. So let's use that as an example, because it's the easiest one that somebody might try to forge. So in order to use child support income, you have to be able to show that you're going to still receive that for 3 years. Well, almost exclusively, child support orders state that they will stop when the child becomes 18. Now, most of the time they'll state that if they continue into school, that it'll continue, but we as a lender can't know or guarantee that somebody's going to continue in school. So we're going to go off the worst case scenario, which is 18. So what you get is you get somebody that goes to a mortgage company, they get denied because they say, hey, because on there it'll tell you how old the child is, at that, their birth date. And so they look at it and they're like, hey, this says that your child's, already 15, which means that it's not going to continue for 3 years. And then they'll be like, oh, okay. And then they'll go apply to somebody else, and you can see where they've doctored the child support order, and instead of the child being born in 1997, the child was now born in 1999, which now means that it continues for further, so now they could use the income. But most of the time, those people are not very good with making sure that everything is correct, so it's pretty easy to spot and catch where you can see that the font or the size or how it's laid out is a little different than everything else, and then it becomes a red flag.
So do you think that y'all will start seeing a lot more people start refinancing, since apparently there's this thing going around that rates are going to go up?
So most people that could or wanted to refinance have already done it.
Okay.
And there was a huge wave of that in 2020, and some in 21. There still are some, but most of the people now that are refinancing are doing more so because their value's gone up, they can get out of PMI on their loan, or it's gone up to where they have other consumer debt, credit cards, things like that They want to take the money out of their home, pay all that stuff off, and just have one debt.
What about when your mortgage is under 100 grand? Is there some sort of split there? I feel like we talked about that somewhere along the line.
As far as,
Like when your balance is under 100, or is it 80? There was something I feel like
We talked about 80%,
80%.
an
Okay.
80% loan to value, we're talking
Okay,
about
okay,
PMI,
that's
but
what it
if
was.
your
Yeah.
LTV is 80 or less,
Right.
then you don't have
correct.
PMI.
And you can
Right.
technically do no PMI at any amount,
What is that?
but it comes,
Okay.
What is-
At a premium.
what's PMI? PMI is private mortgage insurance.
Okay.
And
That's
so
what it was.
basically what it does
That's
is
what it was.
private mortgage insurance allows you to put less than 20% down, but to borrow money like you were putting 20% down. And in reality, and I know that this is gonna sound completely backwards, realtors never even understand it, clients don't understand it. You probably are gonna be like, that makes no sense whatsoever, it's stupid. However, if you come and you apply for a loan, and this is with any company, and you're gonna put 20% down, and let's say we use two scenarios. Let's say you're putting 20% down, a $400,000 house, and you have a 760 credit score. You're putting 15% down, $400,000 house, 760 credit score. Everything's the same, 20% down, 15% down. Your interest rate's better than her interest rate, even though you put less money down.
Scandalous.
It shouldn't be that way in common sense, right?
Scandalous.
Should be better for her because she put more money down. The reason why is because in her scenario, the bank has nobody else to share in risk. That's it. They're on the hook for everything all by themselves. In this scenario, they have a PMI company that is sharing in risk, so they're willing to help to lower the money that it costs.
Interesting.
So it can be more beneficial sometimes to put less money down than it is to put more money down. And the less money you put, the PMI rate goes up, and the lower your credit score is, it goes up. But you could go and you could say, all right, I'm going to do 5% down, and I don't want PMI. Okay. With PMI, the rate may be 4%. Without PMI, the rate may be 4.5 or 4.375. And depending on someone's situation, maybe that is better, because the PMI may actually make the payment a little higher than what the rate would have. Long term, the PMI is going to go away, and then you're left with a lower rate, where without PMI, you're left with that higher rate the entire time. But if somebody says, I'm going to be here 3 to 4 years and putting 5% down, I'm okay, I'll take the higher rate. Okay, let's do that. Because you're not going to be there long enough to see the PMI go away anyway. Take the lower payment while you've got the house and not worry about it. So it's just, those are the things of when we talk to clients of what their goals are, what they're wanting to accomplish, how long they're going to be there, that we go through. We've had clients that literally, and it blows them away when we structure it this way. So does everybody know what discount points are?
Yeah, we talked about lender costs.
Yeah, so discount points are you're basically prepaying interest. You're going to the bank and you're saying, you told me the rate's 4%, but if I give you this, what will you make my rate? And you may say it's $400,000 loan. I'm going to give you 2 points, which is $8,000. They may then make the rate 3.625. So now you're paying less interest every month, but you gave them $8,000 up front. By and large, more often than not, think about a bank the same way that you would think about a casino in Las Vegas. If they offer you something, it's because it's to their benefit. More often than not, it's going to benefit them and not you. And they know that. They have actuarials that put everything together, and they say, let's offer this. More often than not, even if somebody takes it, they won't be in that loan or that house long enough for it to benefit them. And so, but people get caught up on rate, and they're like, nope, I'm going to do it. Okay. And if you stay there forever, 20 years, 30 years, it does pay off. It's more beneficial. But most of the time, people don't do that. Life happens, they get out of it. So what we've done is we've gone the other way in some situations. And basically, we've had people where they're like, listen, I've got another property that we're selling, or, we're going to be retiring and moving. This is just a home for 2 years. And we go the other way and we say, okay, instead of you paying all these closing costs and your rate being 4%, let's do 5% on the interest rate. And we're going to pay those closing costs for you. So now you saved, let's say $9,000, but your payment's $150 more a month. Well, you saved $9,000, you're in the home for 18 months. You just spent $3,000 over the next year and a half versus spending $9,000 now. So it saves them money over the long haul. And so we kind of go the other way.
This is why you need a loan officer that knows what they're talking about.
Right.
When we talked about a realtor and paying the commission or not paying the commission, but they advocate on your behalf and they're of benefit to you because that's the same situation that he knows of scenarios that we would never think
And
of.
they'll walk into Chase Bank and ask for a home loan.
Yeah,
You know?
and that's the deal is, like there are still some people who believe wholeheartedly, and it amazes me, some of them are not people that you would think. So 40 years ago, if you wanted a loan, you went into your bank and that's who you talked to, and you had a relationship and you had a handshake with them and they've been there forever, you've been there forever, and everybody knew each other. That's not the way that it is anymore. And but there are still people who are like, nah, my checking account's at Bank of America, that's where I'm gonna go get my loan. Be like, you understand that loan officer can't access your checking account. You're still gonna have to get all the same documents. It's not gonna save you any time. And in the market that we're in, it can actually be detrimental to you trying to get a home because they're not gonna be as likely to close on time. The communication's not gonna be the same. To give you a perspective, and I use this company because everybody knows them and they know them for a very good reason. So, Rocket Mortgage, Quicken Loans. They spend more in advertising than the next 10 largest mortgage companies combined.
I heard they were high risk.
They charge a lot of money. Like but what they cater to is people that are really just looking at a rate and they don't look at everything else. But if I give you the lowest rate, but I charge you a lot more money for it, that's not necessarily a great deal for you. You have to look at everything together. And so even on their website, like you can go and pull it up now, and if you look at the details, it'll be like, rate is this with 2 discount points. Well, I can do the same rate with way less than 2 discount points, But most of the time, most lenders are gonna quote you a rate with no discount points because people are concerned about their cash right now. But if you're really concerned just about rate, then that's what they're gearing towards. Our CEO, he uses them as an example because our CEO played in the NFL, has a Super Bowl ring, played for the Tampa Bay Bucks. He started the company. But he will tell you, there's plenty of videos of him talking about it. Movement Mortgage will never be on a stadium or sponsoring a sporting event. And the reason for that is that money has to come from somewhere. And so you got to charge the consumers more money if you're spending all that money advertising. Now you go get money, you get clients because of it. It works. Advertising obviously works. A lot of companies do it. We take our money and our name is on schools. So we have a nonprofit foundation, and we open charter schools in underserved areas. So we have 2 in downtown Charlotte. We're opening 1 this next year in downtown Atlanta, and they're fully funded private charter schools that cost the kids nothing to go there. We provide uniforms, teachers, everything to get them out of some of the schools that they're in. So that's where our money goes versus going to be on a stadium somewhere. So.
And when you're in an office, you'll appreciate working with a lender that you can call a loan officer
And
and
they
them on
answer
the phone.
the phone. Yeah.
I can assure you, call Quicken and see what happens.
Yeah.
You get a different person all the time if you get somebody
You explain your scenario all over again.
and I'm this is different than not everybody operates this way, but if somebody's called me while we were here, it doesn't even go to voicemail. I have an answering service that sends it to my assistant, and if she doesn't answer, then the answering service takes a message, but it tries to connect to me and to her before it ever, somebody has to leave a message because things can be time sensitive and things are needed, and I don't want to have to, be like, hey, sorry, I know we're in the middle of this, but I need to take this call. Things have to be done, but somebody else can do it. But it's, it all goes back to, to your question of, communication is the key on everything. If you look at reviews, and to me, it's no different than any other business, where people are involved. When you look at reviews for any type of business where there's products and services and sales involved, every review, whether it's good or bad, is based around communication. If it's good, it's because communication was great. If it's bad, because communication was bad. And you will start to see as you go through it, you will see there are certain places where you're just like, we just know they're not gonna close on time. Like, your day will start where you think you're gonna have, you leave Friday and you think, Monday we got 7 closings. Monday shows up, you got 2. 5 of them got moved because somebody wasn't ready. And it's just what's gonna happen. And you'll see that there will be a consistent theme to who those are that get moved on a regular basis. And unfortunately, no different than anything else, like all the stuff rolls downhill. And so it starts with, everything comes to us and we have to rush it. And then we come to you and be like, I don't know what to tell you. Like, it's closing in 45 minutes. We'll have it to you in 30 minutes. Just close it. And it's just what's going to happen at some point. So.
Are you about to go golfing?
Nope. No, it's just what I wore today.
Yeah, I mean,
Yeah.
that's a nice golf outfit.
Thank you.
I like how your socks
I
match.
do too.
Thank you. I try.
Yeah.
We noticed.
Look nice.
I mean, you're right here.
Yeah.
Can't walk down there,
Yeah.
it's right
I
here.
live on Brookstone, so I
Oh,
play there a
so
lot.
do I.
Do you?
Yeah.
Where in Brookstone?
I live on the 7th fairway, right smack in the middle. You know Nick Gannon?
Shut
That's
up.
my ex-husband. You know Simon Kelly?
I don't know Simon, but I know Nick very well.
Yeah, that's my ex-husband.
So we've met before. I didn't even pay
Oh my
attention to your
gosh,
name tag.
Okay.
So,
Yeah, I'm sure
so,
we have. Yeah.
so, so I
Oh,
know.
It's all coming back. Nick and I had yes.
Yes.
I friended
we
you
were-
Friday night when Nick and I were talking about you.
Yes. We,
Oh, that's
so
so
I play
funny.
poker with Nick all the time.
Yes, we
And I
were
know your
just
boys,
talking
I know your
about that.
boys well from being
Yes.
over at the house. And,
Uh-huh.
it's, yeah, I'll see him tonight. I was just talking with him
Yeah,
earlier.
it's Wednesday
I'm,
after all.
yeah, I'm playing golf with him Sunday.
Okay.
So it's,
Oh, that's so funny, yeah, we just shared a bottle of wine Friday night, we were having some laughs on the couch, I don't know how you came up, but,
yeah, cause I live on the back of the 5th green. And so that's when you said 7th fairway, I was like, hold on.
Okay,
Yeah.
cause I kinda cruise and walk
Yeah.
around on, do the loop.
It's, her ex-husband played college football, tried to play in the NFL, used to be the Southeast Regional Director or whatever for Homeland Security. So,
He's a big deal.
he
Just
is.
ask him,
Yeah.
just ask him.
He'll tell you. He's a super nice guy though.
Yeah, he is.
And your boys are fantastic.
Thank you,
So-
I'm very proud of them.
Yeah, they are. Both very well mannered and good kids.
Thank you.
So,
Yeah.
not that they're really kids anymore, but
Right.
yeah,
Young men,
yeah.
that's so funny.
I will have to tell him that I saw you today.
We'll take a selfie and send it to him.
Yes, that'd be awesome.
Good.
Any other questions?
Super informative. Yeah.
What is, I feel like I know you from somewhere. Do I?
How well do you know Mary Ann?
A decent. Yeah.
She helped raise me.
Okay. What's your name?
Jessica King.
Okay. That doesn't
You
sound
know
familiar, but
Calvary Children's Home?
yeah.
That's where I grew up.
Did you really?
So have you ever been there?
Yeah.
Like toured?
Yeah. So I used to live in Oakley subdivision, right there, and then I coached football at Hillgrove, and so used to do stuff with them, especially during Christmas time with the Christmas trees and stuff.
Okay, how long have you been doing that?
I haven't been over there in probably 4 or 5 years, but was there for about 10 years before that, doing stuff.
And probably.
Yeah.
Okay.
Okay.
Yeah, that's amazing.
Yeah. That's where I grew up.
Awesome.
Yeah,
So.
a lot of good connections in
Yeah.
the
It's
room.
kinda crazy.
I'm just making connections
That is
everywhere.
crazy.
Who else do I know?
I'm trying to think.
Everybody.
Ainsley's gonna be working in the
No, I've
office.
emailed with you.
Have you? That's awesome.
I told him it's a small community.
Yes, it is. It's
That's why he said you gotta be careful.
I was
Yeah.
Don't burn any bridges.
No, it's, that's one of the things that, I tell my staff all the time is, especially from a lending standpoint with buyers is, every home right now has multiple offers. And so as a realtor or as a lender, we can either be the reason why somebody's offer gets accepted or the reason why it doesn't get accepted. Because if all the numbers are the same, but the listing agent says, oh, I've worked with that person before and they were fantastic, I know it'll go well, they communicate with us, they do everything that they're asked of, let's take that offer. Then we helped our client get the home. But if they look at it and they say, oh, the last deal we did with them didn't close on time, they're horrible, now we're the reason why they didn't get the home. And so we have to be the reason why they get a home, not the reason why they don't. So. You got something else?
She's all like, oh, me?
No.
Oh, yeah.
Yeah. Nothing? You good?
I'm good.
The wheels are always turning.
Yeah.
It looked like she was thinking.
We'll probably think of something as soon as you walk out the door.
Thank you.
Yeah.
Well, thank you guys for having me.